Recording is on.
Fantastic. We've got a few participants already here. It is 1 after the hour. Let's wait another 60 seconds here. Tor, John, appreciate you guys hopping on the Zoom. John's at the HQ. I love the nada in the background. Tor's at our honorary Austin facility where he gets to talk with all the tech representatives. For many of you who've joined, this will be your first interaction with Tor, so we'll do an introduction with him here shortly. I'll go over some agenda items and make sure that we keep this to approximately 45 minutes. We will save some time afterwards for Q&A. I know that lots of times we cover a vast amount of information, and sometimes people want to jump into that a little bit more. We want to give you time to ask some questions. During the actual presentation, we will have a few other opportunities for questions as well. We're going to go through some of the specific funds, so don't be bashful about using the Q&A section in Zoom. We have somebody monitoring that so we can answer questions there as we go through. We'll save some time for that after each section, and then again at the end of the presentation, we'll have some Q&A time there, about 15 minutes or so, if I've done my job right and we pace this correctly. If not, we'll answer as many questions as we possibly can. Again, this should take about 45 minutes, and you're going to want to stick around until the end of the presentation. We've got some really interesting promotional news we want to get out there, as well as some coming soon information that is going to be important to everybody who is a city funder. And thanks to those of you who are already investors, who are city funders already. We appreciate you. We want to make sure that we are transparent and we keep you up to date and give you all the information that you're looking for so you can make educated decisions. So again, I think I probably burned up about 60 seconds there on my my initial outlay of stuff. I think we should go ahead. Let's get the ball rolling. We are recording this so that we can save this for future interactions. If for those of you who are watching this on the replay, we appreciate your time as well, whether or not it's good morning, good afternoon, or good evening, or wherever you are in the world. We appreciate you. So let's see if I can navigate my deck and move this onto the next page so that we can, there we go. We can talk about the agenda. So we are very quickly going to go over some introductions and overviews. I've already foreshadowed. We've got Torstein on here today. He'll do a quick introduction. You've got to sit through John and I's introduction. Some of us are old hands. We feel like we're best friends by now. The meat of this particular meeting is we're going to talk about the NAV update. John's going to give us some really great insight on performance. And then I'm going to touch on marketing indications and future trends that we're watching and what's important for us. A lot of people ask consistently for what do we look at in new marketplaces? How do we make acquisitions? We'll give you some insight into that process. And then we'll share some interesting, as I foreshadowed, bonus and promotional items and what's coming next. And then we'll save some time for Q&A. So with that agenda out of the way, I can give you a quick introduction to myself. For those of you who are not familiar with me, my real name is Sundance Brennan. I am the head of acquisitions here at NADA. In essence, that means that I run our sales department. We are the folks who talk to homeowners. We make partnerships with third-party companies such as solar companies or home improvement companies to find homeowners who want to perform those actions and then need cash for it. So I connect our investors with homeowners who are looking for cash. My team underwrites all of those files, make sure that what we're doing is a solid investment, and make sure that overall process from contact and marketing channel updates to underwriting, closing, servicing. So that's my neck of the woods. John, give us a quick update on who you are for those of you who may not be familiar with John Green.
Yep, thank you, Sundance. I am John Green. I am one of the founders of this thing. I've been working on it for almost 6 years now. Amazing to have these other people working with me now in the process. But yeah, I come from mortgage and fintech background. I guess prior to that, a little bit of a character intro as I spent my early 20s as a punk rocker, did 2 albums and toured all over. Very much not a punk rocker these days, but mortgage and fintech's my background, and NADA and Cityfunds is a key part of my life. So then Tor has joined us as our new CEO, and Tor was previously CEO and co-founded CrowdStreet. For those of you that have seen any really any online investing in real estate, I imagine you've seen and come across CrowdStreet. It's a tremendous success. Tori, you want to do a bit of an intro and share some thoughts and insights on the market and related?
Yeah, certainly. Thanks, John. Thanks, Sundance, and wonderful to meet everybody here virtually, and hopefully start meeting some investors in person as we cross the country. As John mentioned, I was prior to this a co-founder and CEO of a company called CrowdStreet. It was really the leader in the commercial real estate space in bringing kind of the commercial real estate investment opportunities online. I did that for 10 years, still on the board at CrowdStreet, and actually got to know John about a year ago, was really very interested in what the team at NAV was doing on the residential side and how they were unlocking home equity as an investment opportunity for individual investors. And that really kind of parlays into my background. I've been in the technology sector most of my career, really helping to bring technology to consumers and to businesses. And people overuse the word disrupt. I like to say transform industries, not turn them on their head, but help them evolve. And I think commercial real estate, residential real estate are two of both amazing asset classes that have been for so long been locked up and closed and private and really only available to exclusive investors. I think that all changed, and I'll kind of lead this into my opening remarks, which is in 2012 with the passage of the Jobs Act. And I think as for our country, right, that was a huge change because our securities laws had really not changed for about 100 years. And so the Jobs Act was a paramount legislative change. Congress and the president actually got together and made the change together, which was wonderful to see. And really, anything like that takes many years to evolve. And so it is, we're 12 plus years since the Jobs Act. It took a couple years for it to play out in different titles, if you will. Reg A and 506C are kind of two common things, the Reg D 506C and the Reg A. And so Cityfunds and NADA took advantage of the fact many years later that had happened. Here at CrowdStreet, we did that early on in 2013. And the story is the same. We're able now to take these investment opportunities and make them available to everybody. And again, it's wonderful to see many companies doing this on behalf of individual investors. And it is done for the investors. And you have to build both sides of the marketplace. As Sundance mentioned, he is out there and his team on the acquisition side finding the best quality assets that they can in the target markets that we focus. And then Dion here, who many of you probably already mentioned, is really focused on helping the investors onboard them, get their questions answered, and help them as they make decisions around what are the right investments for their portfolio. So I just wanted to close by saying, thanks for having me. I love the transformation of what NADA and Cityfunds is doing. And I look forward to hearing from many investors around what you enjoy about the platform and what you look forward to. What are we doing where we could meet more of your needs? And those go into kind of our future strategy, our product direction. And so thanks again, everybody. And let's kick it off with John talking about, I think we're starting with Dallas, John. So let's jump right in. Or we're going to give a little briefer on net asset value and what it means. Sorry.
Yeah. We're gonna break down the primary component here. Thanks for that, Tor. All right. So I really appreciate each of you for joining this. This is, if you are to join a webinar and you are considering investing in a city fund, really getting involved with and understanding net asset value or NAV is the most critical thing. It is how, most simply, we present and you can measure the value of a fund. So just as a brief backdrop overview, net asset value, as a fund, we take investor capital and then we go make investments strategically into real estate. And so that is how we get to what is our total asset value. So what is the value of our real estate assets? And then we're going to subtract what is the current debt or liabilities at the fund. And then that becomes your net asset value. And the way that this is presented to everyone for really any fund is that we divide it by the number of shares that we've sold. So you can see this as effectively a share price, your NAV per share. And it's a simple way to measure what is the value of this thing that I've invested in. We're going to tell you a lot about the activities we're doing that affect and impact that value, but that is really the most critical thing that you're buying. So the next question, let's go back real quick. I just want to break down these other things a little bit more in detail. So how does a city fund calculate NAV? Well, just like I told you, but what's really critical to us is that when we calculate NAV on a city fund, we are investing in residential real estate with our home equity investment agreements. And these are liens against residential homes. That's how we secure the interest we have. So these are real assets. Because they're residential, we're able to access many third-party independent property valuation appraisal tools. We actually use three. We have three automated valuation tools that we use to measure the actual value of the real asset held in the fund, whether it's a new acquisition or one that we're currently holding. And so that way, when we produce NAV, there's no subjectivity. It's very much objective, independent analysis of that residential real estate asset. And how do you track it? How do you experience it? This is something we've tried to build out fully within our app. You can access the app by going to cityfunds.com, downloading our app, Cityfunds, and you can view it right when you get into the app. What are you buying? It's your NAV per share. You can see the charts and really try to experience it throughout. So hopefully this is going to be the theme here, really understanding when this is changing, what it is, and what you're buying is how you can measure and experience the value of a city fund. Okay, so all right, so let's talk about when we publish NAV, and then now that we have this new process, this is going to be concurrent with a webinar where we're going to walk through the activity and the changes and the opportunities. So today, we're in July, we're publishing updates for NAV for 3 funds. We're talking about them today. That's Dallas, Tampa, and Select. What's coming next month in August is Miami and Houston. So you can anticipate that. Great opportunity to get in and see what we're doing in Miami and Houston in August. September, we have Austin and Denver. And then really on deck, we have LA, Phoenix, and Nashville that will be coming soon. And when we get closer, we'll announce the actual schedule that will match with those funds. All right, so we're getting into Dallas next, where we're going. Beautiful skyline. Okay, so what's happening in Dallas? First, let me talk about what activities have we done over the last 3 months that are going to drive the share price, the NAV per share of Dallas. Over the last 3 months, Sundance and his team has acquired 8 different home equity investments across the greater Dallas metro. And these home equity investments that we talked about before, these are amazing contracts that allow a homeowner to get cash out of their home. And then as an investor, we're able to get a lien secured interest in their home. And because of the value we're giving the homeowner, that is, we're giving them cash from their equity without the burden of debt. This is not a debt investment, through equity. We're able to get a really good in-the-money investment in front of the contract. And you can see that in practice here. We spent $552,000 to fund or acquire these 8 HEIs. And the current mark-to-market value of these contracts is $726,000. You can see how much in the money and how much new acquisitions are really driving net asset value for our fund. More specifically, you can see that in May of this year, Dallas was trading at $11.50. And once we update the NAV coming soon in Dallas, which will be on the 18th, it will be trading at $11.69. So that's about a 2% NAV appreciation in Dallas. And then this is a bit of the components. You can see they're directly driving that. But one of the themes here is because we have to announce that NAV is changing because of new acquisitions slightly ahead of the repricing, it does create this opportunity window where you guys as investors can look into see, okay, what have we done in these funds? What is upcoming? And then, now is the most optimal time to consider an investment in any of these funds that we're talking about because of this window. All right, let's see. We thought this was going to be something consistent to add to each of our city-themed funds, as well as our greater market fund, is let's compare what has happened in the Dallas metro residential home prices over the last 12 months. In this case, you can see the residential home prices, the average selling price has moved just slightly in the last 12 months. It's up 1% over a 12-month period, July to July. Our Dallas City Fund has appreciated 10 times that at 10.39%. And this is a direct reflection of the value of the type of investments we're making with our home equity investments and our abilities on his team to source the right deals to invest in. So in fact, we have outperformed the Dallas market quite exceptionally here. When you look at this from a dollar standpoint, you'll see, like, how do I get to 10.39%? How is that realized to me if I'm an investor? Well, if you would have bought a share in Dallas in July of 2023, you would have paid $10.59. And then as of the 18th, that share value will be published as $11.69. Again, because of the real asset value held in that city fund. All right, Sundance, you want to give us a little bit of market insights? What's going on in Dallas? What are we paying attention to?
Yeah, absolutely. Before I dive into some of the specifics, I just want to reiterate some of those points and really drive them home. Like, John, when you're talking about those numbers, I'm always in awe at how well we do with the acquisitions that we make. For instance, the Dallas market, the home price appreciation was 1%, which doesn't even outpace like inflation. So essentially, like, if you had invested in real estate just on your own, if you bought a property a year ago, you would have lost money, relative to inflation. You wouldn't have done well. However, you saw the city funds update in the last year, and that was 10%. So you would have outpaced inflation via city funds. And the way that we do that is by studying the trends, looking for particular markets, making the right acquisitions. And what types of things are we looking for in Dallas? Well, first of all, we're happy to be in Texas because Texas is an economic juggernaut. In the United States of America, the GDP of Texas outpaces countries. So the amount of business that's coming into Texas and the migration specifically to Dallas, Fort Worth. You see in here the Prosper Arts District. You see something regarding the airport. These areas are not in Dallas proper. So just to clarify, our Dallas city funds, and all of our city funds for that matter, aren't just the specific city. It's the MSA, the Metropolitan Statistical Area, which includes, in Dallas's case, places like Plano, Frisco, Prosper. Now, Plano, Frisco, Prosper, if you look at the top growing cities in America, those cities rank in the top 50, sometimes top 25 in some cases, just on their own. And they're just suburbs, essentially, of Dallas. So we get to take advantage of all of those surrounding areas. Now, in particular, we've highlighted these 3 projects because they bring in lots of new jobs. New companies are headquartering here, lots of shopping, lots of things that draw young families, young professionals who are going to need housing. If you look at migration statistics, it's almost cliche at this point to talk about the migration into Texas over the last 4 or 5 years. And that trend, even though it has slowed some, is still progressing. Even in a down year, Texas is still poised to add 350,000 jobs this year, which is just an astounding fact. And almost 2/3 of those are supposed to be in the DFW area. So Texas, over the next 2 years, 700,000, 2/3 of those are coming to the Dallas-Fort Worth area. So we're really keyed in on where is job creation. And Texas, like I mentioned earlier, is a juggernaut in the economics division. People love the tax incentives the state of Texas offers. New businesses are coming here. Existing businesses are relocating here. If you look at that map, you'll see some very familiar names like Kellogg's relocating from Battle Creek, Michigan to have a significant presence here. So companies are relocating and they're going to need job force here. And sometimes we have folks who, are looking for those jobs locally, but oftentimes there's relocation package is, extended out to those folks. In fact, there are entire businesses whose dedication is solely to helping companies relocate to the state of Texas. So for that reason, and lots more, we're happy to be in the Texas markets overall. So hopefully that gives you a little bit of insight into what we're looking at and why we're so excited about our Dallas and DFW, city funds and investments we have really all throughout Texas, but specifically for DFW for this particular quarter. And we'll talk about some of those other locations in future webinars too. So hopefully I gave us some insight there. We're right on pace, everybody. Just FYI to hit that 45-minute marker. John, I'm going to hand it back to you to talk to us a little bit about Tampa and what's going on with these 19 assets and how well we've done there.
Yeah, well said, Sundance. I'll just reiterate one point, just how we can really focus in on key markets. So when you look at the greater MSA, you can find, it's sometimes easiest to package and present around the largest markets, like what is happening here to drive demand, and then really the home price market. It's a supply and demand, very simple market. But we can take that same analysis and go very deep into Tampa. So Tampa, you can look at St. Petersburg, what's going on there, just like what Dallas with Prosper. There's the level of access we have and opportunity within focusing on the greater metro has a lot of opportunity to drill into very specific market activity, which is always realizing the value here. So let's look at Tampa. Tampa is not quite as seasoned as Dallas. It was the fourth fund we went to market with. And in the last 3 months here in the Tampa market, we made 4 new acquisitions, spent $245. Current value of these assets is $292,000, roundabout. And you can see this is a substantial movement in NAV per share. So we have tremendous in-the-money new assets. But in addition, Tampa is a really strong performing home price appreciation market. So our existing assets there have appreciated at a consistent rate as well. You can see that experience in the NAV for Tampa, where, again, in May, Tampa was selling at $11.31. As of the 18th, when we update the share price for Tampa, that'll be $11.78. A very big period movement here of over 4% appreciation in the NAV. For existing Tampa shareholders and any of you looking to buy, now would be the opportune time to buy shares in Tampa ahead of this share price update. So similarly, as I said, 1% versus 4% home price appreciation over the last 12 months. Still pretty stable relative to a longer term view and how these markets have done. Markets are not in these peaks where they're in the double digits year over year. But fundamentally, we recommend that real estate, you look at it over a longer horizon instead of even a year over year. But this does give you just a really current specific comparison. Tampa residential home prices have appreciated by 4% over the last 12 months, yet our Tampa City Fund NAV has appreciated by almost 18% over that same period. So this creates a tremendous opportunity. What you can see with this fund, because it is a bit newer, is that in the 12-month time frame, it was still trading at the initial offering price, which is always $10. Because it was at $10, we started updating and acquiring assets, and now as of the 18th, the new price will be $11.78. So tremendous appreciation for current Tampa shareholders. Great opportunity right now to buy some shares in Tampa before the price updates because of the very strong market appreciation and our ability to source assets in the same market.
The appreciation that you see there, the 4% for Tampa. Tampa is just of its own accord doing a little bit better than the Dallas market. It is holding its own essentially with regards to inflation. The Fed is really fighting hard to get inflation down to 2%, John. So I think that Tampa market is really poised well to take off here shortly. That's my opinion. I'm really bullish on the Tampa market. And I love to see that we've already achieved that NAV increase of 17 point some odd %, which is right in line with our targets, even in a difficult market. So as long as we keep doing what we're doing, I've got high hopes for the Tampa market. Broader strokes for Tampa in general, they've got a lot of great infrastructure going on, and they're a little different than Dallas because they are attracting dual sets of populations. So they are, on one hand, it is a huge migration point for retirees. It's kind of the old joke, people get old in New Jersey and they retire in Miami. Well, they're not moving to Miami anymore. A lot of them have been priced out. They're moving to Tampa and St. Pete. Little safer as far as weather goes. It's on the inside coast. It feels a little different, and that volume of influx of retirees is growing, and those retirees are gobbling up a lot of the single family residents out in the suburbs, and they're eating up the market share and the supply of homes that's out there. Now, on the other side, Tampa has a great industrial core that's there. They also have a lot of tech growth there. They have a lot of healthcare growth there. So it's a really, really broad strokes, job creation and education. So they've got a really, really cool system where they have encouraged folks to relocate there for educational purposes. There's a couple of really top-notch like universities and specialized education, especially in healthcare, that are located there in Tampa. And because they've got all these retirees coming in there, the healthcare workers, they stay in Tampa. So they've got a good, job, base that's growing there as well. So you got this combination of young people coming in, moving to downtown. Now they might live in a condo to start with. There's a lot of really cool like downtown infrastructure things going on. But really what I like is the transportation stuff that's going on in Tampa. So they are facilitating transportation from the suburbs to downtown via rail in a lot of cases. They've got a really good like bus transit system, which bodes well for the future acquisition of single family residents by those up and coming tech workers or healthcare workers that are in Tampa. So we're really watching infrastructure in Tampa more so than like relocation of headquarters like we are for Dallas. But that bodes really well for the housing market there, John. So we feel bullish on it. We still like Tampa a whole lot, and as you can tell, it's outperformed Dallas a little bit. Not to say that Dallas, like our headquarters are in Dallas. I still love Dallas a lot. Like I still believe strongly in it. But if I had to go back in time, I'd put all my money in Tampa. Now we'll see what the next year brings, but Tampa so far has been a good performer.
Yeah, well, so it's definitely our leading horse. I would just add a little bit of a real world application to how Sundance and his team are helping homeowners with our investments there. The majority of the homeowners in the Tampa market that we're investing in their home equity are actually using that cash that they're receiving to invest in solar for their home. So looking to add efficiencies to their home. And for us, as asset managers, we love that. Because they're taking cash out of their home and putting it right back into the property to bolster the value of it and sustainability of the same. So many reasons that, as Sunnet said, we're very excited about Tampa.
Yeah, right after we invest in the home is worth more because they took the money and essentially reinvested it. So that's great. All right, we're going to zoom way out and talk about Select, John. So I'll tee you up with the Select product and just kind of inform folks that Select is our overarching catch-all for opportunistic investments. Select invests individually in lots of different locations. I think John will touch on that, but Select gives us the real sort of ETF style investment across the country.
Yeah. So Select is a newer fund relative to the other two. Select is it is an accredited investor only fund to begin with, and part of that is because of the creative construct that we went to market with Select. Select has the opportunity as a fund of funds where we manage the capital very actively with Select. So investor capital, we can go and, well, as an example, we acquired a lot of shares in the Tampa Cityfund at the initial offering price at $10. So Select owns many shares of $10 initial offering price in Tampa that we're all seeing that appreciation happen right now. So the investors in Select get to experience that. But we're able to selectively invest in the underlying city funds that we know we're managing, and we can really say, okay, well, where's the best opportunity? We manage your capital, we put it there. In addition to that, Select makes investments very opportunistically directly into home equity investments. And these are typically in other markets that are outside of where an existing city fund is, even state. And so they're truly driven based first on what is the best investment opportunity. And that's how, again, Select is kind of the theme. It's a select type of HEI, a select type of exposure to a certain city. So this really creates some unique opportunities as to how we manage the performance and capital in Select as a fund. So in this case, just to go back real quick, Sundance, in this case, we are only presenting the investments made from Select into direct HEIs. So over the last 3 months, we made 5, we paid $385. These are worth $464. And then we can again see the share price. So share price on Select is slightly different. We initially went to market at $100 versus 10. That's why you see the larger numbers, but it moves relative. So this period, the movement is right at 1.5%. And Select has some really great headwinds in terms of where the 5-year horizon of the fund is going. So let's look at how Select is doing relative to U.S. market. So Nancy, we'll flip the slide. So the home price appreciation that we're listing for Select is just what is the national average that we're seeing, and that is right at 4% over a 12-month period. Now, Select has only been an active fund for 10 months, so it's been active since October, so it doesn't have a full 12 month. So when we look at this appreciation of 15.42, it is taking that short duration of being launched and then annualizing it so we can get a sense of where it's going. Select is the fund that has a high return target in the 18 to 20 plus range is the 5-year horizon we're looking for with Select. There's a lot of the flexibility with that we have with how we can make investments and manage the capital within it. And so really, when you look at it, if you are an accredited investor and it has a with the 3C1, bit technical, but you can, just like with any of them, you can invest in this directly from the app, but you could also schedule at each time or Sundance or even myself or Tor to discuss the opportunity to get into Select and what that means. And again, with all of these funds, you have right now is the best opportunity because as of the 18th, these new share prices will be published and that'll be what you're buying at. Right now, you still have the opportunity to buy at the current share price. And we're giving you this insight so you can see what's happened in the funds. It's really going to drive the value of your investment. And then we're going to end here with an extra bonus offer that we're laying to that to add more to it. So let's see where we're at on the presentation for that. Market insights.
John, I was so excited. I couldn't wait to talk about all the good stuff. I was trying to rush you. I apologize. I was trying to change slides on you. There's a lot of good stuff going on. We did have a quick question that seems relevant to Select. And at the top of the hour, I said, hey, we'll sprinkle in a few questions there. Will there be an opportunity for Regulation A, folks who want to have a wider pool in either Select or a yielding style, investment opportunity? If so, what's the timeline for that? And if not, how would somebody go about, kind of creating sort of that recreating some of that mixture there?
That's a great question. So first with Select, as it's designed, the short and direct answer, as Select is designed, it would not be an eligible type offering under the Reg A to where it could be open market because of the risk management with investing in other funds. But that doesn't mean that the effect, a similar way where any investor on the platform can get more, one-click exposure to multiple markets. And so to that end, can you get easier access to a broader market? Yes. Can Select be Reg A? No. But we are working on product features to make it easier for all investors to get more diversified market exposure across city funds without having to go pick and choose the different markets. We have additional offerings that we're going to launch that could help you achieve very similar outcomes. Regarding yield, any type of income-based fund, we don't have any immediate plans to bring those to a broader market, but it is something that is allowed, and it is something that we are definitely going to do at some point in time. I don't have a timeline that I'd be comfortable sharing on when we're going to do that right now.
In the meantime, I would recommend folks to take a look at setting up recurring investments with a self-directed sort of pool. So you can self-diversify. One of the nice things that we do, John, is that we've got all of these offers all available on the app. So if you want to put $500 on here and $500 on here and $500 on here because you feel strongly that, hey, you want to be in, LA, Austin, and Denver, well then so be it. You can kind of create your own basket that way. I like that approach. I personally do something similar to that right now as well. So I think that you can manufacture that opportunity, and also that brings into play sort of the dollar cost averaging style of investing that a lot of people are interested in. Also helps you manage just your budget. I personally, I play this game. Robert Kiyosaki's got this game called Cash Flow. And I play this game with all three of my children. And one of the mantras is on payday, you pay yourself first. And so you invest in whatever it is that you want to, so that you've got something kind of set aside for the future. So I would encourage folks to pay themselves first, invest in their future, whatever it is. I personally prefer city funds, but if it's not city funds, for all of your basket, you should diversify. I would definitely recommend that folks pay themselves first. And I like that dollar cost average model too. So that's my pitch for Robert Kiyosaki's Cash Flow. No affiliate agreement needed, but I do like that game for those of you who've got family out there. All right, so broad strokes. Let's look at what we target, what we think about the overall housing marketplace. I get asked these questions a lot, and if I had a crystal ball, I'd be a very, very, very rich man. I probably would not be here, but I don't have a crystal ball. But we could take some educated guesses and tell you what we look for. So things that we are excited about that could impact appreciation and the value of NAV in the coming year. First up, it's policy. So it's an election year. So there are some policies in place, and everybody wants to claim, credit for these types of policies. But the bottom line is that the consumer, the homeowner, I think is likely to win. It looks like one of these policies is going to get pushed through, would be my best guess. Either a $10,000 first-time homebuyer credit that gets, as a credit back to your taxes in $5,000 increments over the next 2 years. That would be a boon to homeowners because new homeowners would be encouraged. They might overpay. They might increase. They might put in an offer in that's a little higher because they know they're getting $10,000 back, John. Next, we've got a $25,000, essentially like a down payment assistance program. $25,000 is a lot of money. That will move the needle as well. So if either one of these things gets activated, you're likely to see some more bidding style activity take place across the US. So that would have a universal impact for first-time home buyers. It would be a rush to take advantage of this money. Now, there's no limits or caps on the dollar amount, but sometimes people, they want to make sure that, hey, I take advantage of this before the program goes away. So there's that effect as well, sort of the first-time home buyer FOMO, if you will. Interest rates. So people always talk about interest rates. How much does that impact you? John, if interest rates go down, is Cityfund still a profitable business? Is it still a good investment opportunity? My opinion is that volatility is our friend. Because of the way our model is, rates go up, rates go down, we're in good shape no matter what. But in particular, this year, I think that a couple of key things are going to happen. So we are probably going to get one of these incentives. It's going to be fantastic for that new purchase, that new home buyer. Interest rates might help somebody move from one product to another product or refinance, probably help some purchases as well. So when interest rates fall just a little bit, then people can put their house back on the market. Right now, we've got kind of a tight supply. We've got about 3.5 months worth of supply. Professionals smarter than me think we should have a 6-month supply. That's healthy for the US housing markets. Now, if interest rates fall just a little bit, I put a quick example there for us. We've got $500,000 at 6.5%, monthly payments $3,160. Now, here's something we don't normally think about. $500,000 house, or May of 2024, the average house in the US was $419. By the way, it was $396 the year before. So we are up. We see that across the board. It's not like anybody is losing a significant amount of ground. We are up. But let's say it's a $500,000 house. It doesn't actually cost you $500,000, John. Unless you got $500,000 in your back pocket, you're not talking to me about. Because what it really costs you is 360 payments of $3,160. That's when we think about it that way, that's significantly different than saying, hey, it's a $500,000 house. What it really costs is 1.19 million or 1.12. Trying to do the math there. It's over $1 million is what that house actually costs you. Now, the interesting thing is today, right now, interest rates are a little higher. They're 7.5%. So, hey, what that really cost me is 360 payments, $3,160. Well, me as a homeowner, 35% of my paycheck is only $3,160. That's all I can afford, John. Like, inflation's a beast right now. Like, I can't go over $3,160. So the house value has to be $450,000. Supply and demand. Homeowners can sell their house for $450,000 because the interest rates are at 7.5%. In a few months, I predict the interest rates are going to fall down, maybe not a full percent, but in September, The Fed has already indicated that they're likely to drop interest rates at least a little bit. That's the indication. So, never say never. We don't know for sure. But if interest rates fall down to that 6.5 marker, almost instantaneously, John, I predict we're going to see a significant house increase in appreciation because the monthly payments are going to be the same. Now, obviously, one of those scenarios is better for our investors, right? The house actually costs the same dollar amount, but we want the house value to be $500,000, not 450. Homeowners right now looking to sell, they realize what that is. They're going to see what the market will bear. That monthly payment's going to stay the same. They're going to list their house for $50,000 more on average, 10% appreciation. I think it'll be probably a little less than double digits. I'm not predicting double digits. Nobody hold my feet to the fire on that, but I am bullish. Election year, interest rates falling, some housing incentives go out. I think we're going to see a pretty significant boost in home appreciation. That's my professional recommendation, is that we're going to see that towards the end of the year in Q4 here. And we'll see what the trend holds true if my predictions are accurate. But that's what I think. That's what I'm thinking about, and what we're watching closely to see. Okay, when is the right time for us to really deploy significant amounts of capital to make sure we take advantage of that at the right time? Did I do a good job explaining that? Yeah.
Very well said. Very passionate. I appreciate it. I will, before I go into this, I will say one additional thing that really is of high value when you have more affordability and more velocity of home sales is the payoff cycle of our home equity investments. So whenever a homeowner decides to sell their home, which in this scenario we think more could be compelled to do so because of the market, we're able to then take the capital that's repaid to us and recycle to invest in a new asset. So it creates a compounding effect to generate greater returns, greater NAV for you guys investors. So when we see that velocity of home sales, it creates a tremendous kind of a flywheel effect, if you will, of the funds and the assets and to you guys, the net asset value, the opportunity you guys have to earn value by investing in the fund. All right, so for a while now, we've ran different incentive programs where we want to give new and existing investors opportunities to really maximize their dollars spent in value gained by investing in city funds. So right now we're running a very limited time that right before this new share price update happens in the Dallas or Tampa markets. Reminder, these two are open to anyone. You do not have to be accredited to invest in them. If you are investing $10,000 or more in Dallas, then we, the manager, we're going to give you a 5% extra amount of cash contributions to give you more shares. So right off the bat, you're getting a 5% bump paid for by us. In addition to, you're going to hold shares that are going to soon be worth more because the new share price is going to be updated on the 18th. So you have two opportunities there. One, the best opportunity for Dallas and Tampa is $10,000 investment or more. We will finance 5% extra for you to get more shares in Dallas or Tampa. And then additionally, we have, if you're able to invest $1,000 up to right at that $10,000 mark, we'll give you a 3% match for your investment. That has to be done before the 17th, the midnight on the 17th is when we're ending this promotion because the prices are changing on the 18th. So it is a very limited time opportunity. Hope you guys are able to see it and take advantage of it. Now, the greatest opportunity is in select. So this is to those investors that are accredited. We have a similar 5% if you're able to invest $25,000. We're capping this at $100,000 because the cost is borne by us. And so the maximum amount that you can get would be $100,000 into select. We will finance 5% extra. And then you have shares that are soon to appreciate. Again, take advantage of these opportunities right now on cityfunds.com. To log into the app, you can schedule a call with our investor relations team. Email us at Sundance. You want to give the contact credentials where people can engage us.
hello@cityfunds.com. Hello. People watching this on the replay right now are so bummed out, John. Unless they're watching the replay before midnight tomorrow, because we're recording this on the 16th. So again, that promo ends on July 17th at midnight.
That is right. So I hope you guys were able to gain a lot of information here from us. Know that this is one of our core initiatives going forward is more consistent communication, more webinars, more information to everyone to make informed decisions and invest at the most opportune times.
Good stuff. We are right on time. It is now 45 minutes into this, so we did very well there. It is time for Q&A. We do have a few questions queued up here, so I'll go through these, and I think, John, probably most of these are going to land in your court, but let's go through them kind of one by one and piece them together here. So first one is right off the bat regarding the incentives there. We do a lot of incentives. So you do a lot of incentives. How does that not dilute the funds? Where's all this extra money coming from?
Great question. We, as a manager, are paying for those shares. So there is no dilution. Whenever we offer a promotion, we are absolutely funding the dollar cost of those shares to give to investors.
Comes out of essentially, it's almost like a marketing budget. Instead of advertising on radio or TV or going out to find new folks, like, we are dedicating what would have been allocated possibly to a marketing budget to purchasing these shares to incentivize folks that are already in our audience.
Yeah, and to be very, very clear, we are financing the purchase of the shares that are being granted to the individuals that are receiving them. So the shares are issued to those individuals' name, not ours. We're just the finance behind it, but we're not giving shares without cash being behind it. That would be dilutive, and that is not at all what this process is.
Yep, no dilution. Quick question. So some of these folks on here clearly have been following us for a little while, and it looks like some of them have invested in WeFunder. Our WeFunder campaign is now closed. However, there was an incentive on WeFunder. You had in that coming soon section, John, something about Nashville. And there's a question that goes out that says, hey, how soon will we receive those Nashville shares? How does that process look like? In general, you could probably just touch base on any kind of a promotion, really. How do new shares get issued?
Yeah. So first off, anyone that did invest in NADA, the company, the venture investment on WeFunder, thank you. We appreciate you as joining us as an equity stakeholder. And yeah, if you are eligible for one of the incentives that we offered regarding Nashville, it was an exclusive first market offer where Nashville shares would be at the initial offering price of $10. The way that you would advance your eligibility would be, first, you have to create an account on the NADA platform, because we are an SEC regulated platform. And you just process your information to make sure you have a fully approved signed up account. This is KYC AML test. And once you've done so, you can engage with our team if you don't hear from us proactively. But we do have the list, and we are intending to send a proactive communication out to everyone. So I think the best thing is know that you need to create an account, and know that this week or the first of next, we are going to send a communication directly to you to give you more instructions as to how you can activate that.
Good stuff. Here's one I think we can answer live. So will there be any type of referral program to get other people investing with all of us? This person would like to see some type of an affiliate program, it seems like. What are the restrictions? I know there are some regarding, SEC, can we pay on commission or performance base? But, what opportunities are there for folks to make referrals or affiliates? Do we have any insight into any of that?
I think the most direct thing is, yes, we do want to build out a referral program where our network can grow, and then they can share in the growth of it. Speaking explicitly to the compliance as to what's allowed or disallowed is something that we need to have further discussion with legal counsel on to ensure we know exactly. I just don't want to speak out of turn. We do know there is quite a bit of precedent that you can offer incentive programs where current investors are able to refer others and share in the benefits of that. But how and the details of it are still something that needs to be ironed out. Is something that's on a roadmap. And perhaps, Tor, would be a good opportunity for you. You very patiently been listening to Sundance and I rattle off stuff. I thought you were running away a minute ago. You operated a little real estate platform. How did you guys experience referrals?
Yeah, I'll kind of second what you said, John. We do need to make sure from a legal compliance perspective that we follow, the guidance there. And I think, the other lesson learned, from my years at CrowdStreet is when we roll it out, we really want to make it easy to use, right? Technologically enabled, because as you can imagine, trying to manage referral programs can be a lot of back end kind of support. So we want to do it right. We want to make sure we take feedback, and it was great to actually get it as part of the question of, like, here's an example of what would make a difference from a referral. But I think first we would also go out to the whole investor base and ask for feedback around what would they find interesting. Because when we roll it out, we want it to be set up properly. We want it to be something that really does move the needle. And I think, the best new investors we can find are ones that get referred from our existing investor base. So we have not, again, built that out yet, but I think when we do, it can be hugely beneficial, both for our existing kind of investors who many times are advocates for city funds, but also for the new investors coming in already are kind of, again, are getting that warm referral.
Well said. So see everyone, this is part of the value we're going to be able to gain from tour is whatever lessons learned, trips, traps, etc. We're able to navigate them very quickly. Great feedback.
Yep. Couple more questions. It looks like surrounding pipeline, liquidity, and maybe also liquidity in a roundabout way. So this next question I think I can handle here. So what's in the pipeline and what acquisitions are coming up? We are licensed currently in 14 different states. We have acquisitions, as you saw, in I think 7 different states at this point in time. So some states have yet to be activated just because we want to make sure we are investing where investors are investing. And we want to make sure that we are familiar with markets. So it's really important to us to do our due diligence in every location before we make an investment. But you'll be happy to know we've got $2.4 million in the current pipeline that's activated across 4 different states currently. And we are always prospecting. So we have lots of properties, applications in process. And John alluded to this earlier that Tampa specifically, we have a lot of solar partners there. Our solar partners are actually nationwide in a lot of cases. So they send us leads and homeowners who are interested in this product, maybe in locations we're not ready to invest in yet, but we have a very deep bench to pull from and evaluate acquisitions when the time is right, when we activate new markets. So $2.4 million in the pipeline. Acquisitions is not an issue in this particular market. There are folks who want to stay in their house, but sell part of their equity, even if they're selling that equity effectively at a pretty significant discount, which benefits our investors. So that's good. So hopefully that answered everybody's question about the pipeline. Liquidity. So how does Cityfunds make money and how do I make money? John, that's a pretty direct question. People wonder that.
Okay. I for pipeline, I want to, I don't know, not tease, but just share something that's a little early, but we are very near activating a meaningful credit leverage facility against city funds. To date, our investments into the HEIs has been predominantly equity based, and I just am going to hope that most of you understand like the benefits of adding leverage and how it increases the velocity of us acquiring new assets. So a bit of a teaser because I don't want to overstate too much stuff, but we're very near adding some meaningful leverage which will drive and really accelerate that pipeline opportunity, as Sundance said. Okay, so liquidity. How does, seems like it's 2 questions. I don't know if it was intentional, but I'm just going to answer directly. So what you are buying today is a share, right? An interest, because these are LLCs, but a share. And that's when we've been talking about net asset value, and it has a certain value driven by all the activities which we're talking about. And the way that these funds are designed, these are equity funds. So you're able to create greater return, typically by the design of this fund, by holding your shares longer as they appreciate. And then the way that you are able to realize that is primarily going to be through our secondary marketplace, which is an SEC registered alternative trading system operated by North Capital, which is a broker dealer. The platform is called PPEX. It has a longer name, but it's commonly referred to as PPEX. And this will be similar to how you buy and sell shares in a public market in just its function, but less liquid and really only those that are on platform. So if you're currently holding a share and you would want to list it for sale, then another investor would have to match, and we'll have a system to make that possible where you can sell it, and that other investor can buy it. We are currently on track. Our intention is to release the product features to activate secondary trading for the funds that are mature to that state by the end of the year. There's a lot that goes into this. We do have the broker dealer and the SEC registered ATA business relationship today, which is part of our public filings with the SEC. And so currently where we're at is that our intention is to have this released on platform by the end of the year. We still advise everyone to look at their investment over a longer term horizon, because activating this and realizing it, they're just different stages. But it will be that you have a share and you're able to sell it to someone, they buy it, and that's how you realize that cash value. Tor, is there anything else you'd want to add in terms of secondary, maybe roadmap?
Yeah, I think, again, anytime a secondary marketplace is built, usually people realize that you're selling it probably at a discount because you're getting out early, right? The time horizon on these investments is usually 5 years. So I think, as investors come in, they should really look out at a 5-year and an IRR type of model of what they're trying to earn, because this is private real estate, right? It is not a public market. It is a private real estate investment market. And there's actually a benefit to that. There's a benefit from an illiquid kind of residential real estate market like this has built-in kind of higher returns. And we actually demonstrated some of that on the call here in terms of that opportunity in that private market to make an outsized return over time as valuations go up.
Well said.
Yeah, I think sometimes the nature of that question leads me to believe that there is some conflation between NADA and city funds. And it's very easy to do because we talk about them sometimes almost like they're interchangeable. But I should say that city funds is different than NADA. NADA is the parent company. We manage city funds. NADA is an originator. We originate these home equity investments, these agreements. It's a second lien. It's almost like a home equity line of credit in like the way it's structured for the homeowner. The homeowner pays closing costs on those. Now, city funds, when city funds, a question comes up, how does city funds make money? City funds doesn't make money per se. City funds makes money for investors. If city funds making money, then investors are making money. NADA doesn't have any additional ownership stake of city funds other than a small, management fee. And quite frankly, it's really almost a wash as far as like, the actual cost to manage city funds. So from that perspective, city funds, profits or gains from those types of investments flow through to investors. So there's no separate city funds business per se. So not as the separate company there. All right. We do have one more question, but we only got 3 minutes left. And really, this one is almost kind of along those same lines. How do homeowners pay back their, investors? And maybe they want to know not just how do they, but why would they and when do they? They're like, there's a whole that might be a whole webinar just by itself. John, do you want to take that one? Do you want me to take that one?
Yeah, I mean, I can take it generally. So
yeah,
when we invest into a home, it is someone that, unlike getting a loan or a HELOC, something like that, typically it's driven by a life event. It's more just someone is in their home and they're looking to get solar, they're looking to finance an accessible dwelling unit, these type of activities driving it, where it means of paying for it. So what this does is it means that we're investing in homes and homeowners that are like in the cycle of their ownership. And there's decades of data that tells you, based on servicing rights of homes, what the predictability of when that person that owns a home is likely to sell their home or refinance their primary mortgage. So these are your two primary triggers that are bringing our lien against that property to the table, and that triggers a repayment. So in the event that the homeowner is selling their home, then maybe similar to how people for years have paid it quite a bit in real estate brokerage commissions out of that sale, kind of a couch money outside out of mind. It's a similar transaction to where the repayment is paid out of the sale of the property, and that's the driving event because they get the benefit of the cash. The homeowners are quite comfortable with the cost of it, but the repayment is upon sale. Similarly, it is on the refinance of a mortgage. It would bring us to the table. And so if there's cash out in that event, we would be getting our opportunity to get repaid at the current appraised value and our share of the property. And when you look at this asset, and again, you look at those homeowner statistics over the years, we look at a current portfolio of these, and typically right now we're seeing 15 to 17% of them are repaying per year. When we get to a higher velocity of people selling their home, as Sundance had alluded to, we're going to be closer to 20 to even 25. And so there's going to be different ebbs and flows. And to date, we processed quite a bit of repayments, predominantly because of the current interest rate market on the homeowner selling the home. So these are your two primaries. Now, the contract is 10 years. So let's just assume we reach the end of 10 years. It is a enforceable lien that where we could compel a sale. But our typical scenario that we want to work at for the homeowner, just so you guys know what this outcome would be, is that we look at the investment to see, is this a good opportunity to reinvest into this home and extend it further? And that would be really our first workout scenario that we'd look to do, so that someone's not hit with this big payment due. But all the same, we do have the right to go trigger that and recover that capital. But these are your typical triggered liquidity events. What is also forming now in this asset class is a more established secondary market. We've had DBRS and KBRA, two known securities rating agencies that have recently published ratings for the home equity investment agreement. And that brings more institutional capital to the market. It increases liquidity opportunities because now there is a secondary market, a rating agency that's effectively validating this as an institutional grade asset. So there's ways in which the homeowner triggers repayment, and then the fund receives it most prominent. And then additive informing is we have the ability to sell these assets for a gain out of the fund to institutions due to the maturation of the securities ratings.
Great walk through that, John. I like the fact that retail investors, individual investors can invest in a product that institutions are also very interested in,
Yep.
in a financial product that's able to move around.
Yep.
So that's really intriguing. Hey, we started a minute or two late. It is 2 minutes after the hour, so I think target hit. Final words, John, we'll go to you, and then maybe Tor, if you've got something else.
I'll be quick and to the point. Just those that are interested in investing, now is your right time to do it. Any follow-on questions, ask us now, because this is the best opportunity. Tor, you want to close this out?
Yeah, and I noticed, I think Dion's putting his contact info in there as well. So if you have immediate questions right after this, schedule time with Dion. He will definitely love talking to you. And again, thanks. This was my first Cityfunds webinar, not the last one. And thanks for the questions. Keep them coming, whether it's on the webinar or as a follow-up. If you've got questions, I'd love to hear it. And also feedback about what we can do to better meet your needs in the future. New product ideas, new solution ideas, referral program, things like that. So thank you, everybody, for attending. Sundance, thanks for taking us through it today.
Yeah, thank you, gentlemen, for going on the journey with us. Again, if you got additional questions, I apologize. We couldn't get to everybody. Jig, yes, this recording will be available later. Go ahead and message Dion now. Check the chat. Dion's contact information is there. If you got those follow-up questions, we'll be happy to address them. Thanks, everybody.
Thanks.